Good morning, good afternoon, or good evening, and welcome to the Bull versus Bear webinar on today, Thursday, the 15th of February. Welcome, everyone. Apologies for the slight delay in here this morning. Going to go through our usual regular run through in here today, but before we do, just a heads up for those of you who join us regularly here on the daily webinar. No webinar tomorrow. No webinar tomorrow on Friday, 16th of February. My birthday, and I'm taking the day off from doing this anyway. I'm sure I'll be still busy doing other stuff, but yeah, I'm taking the day off tomorrow from the webinar as it's my birthday. So there you go. Happy birthday, me. Yeah, no webinar tomorrow. We'll send. I'll leave a note here on the message just below, so you are aware, and then you remind you if you do come in tomorrow, and we're not running the webinar. So no webinar tomorrow on Friday, the 16th of February. We're going to go for our usual run through here today. We'll look at the fundamentals, the macros, what's going on in the markets right here, right now, and then we'll take a look at some of the technicals as well. So first of all, on the overnights, it's basically bad news, but markets are holding on to the rebounds that we saw yesterday. We did talk about the markets rebounding yesterday. They continued those rebounds. They'd already had a significant rebound in here. We had the same birthday, Joe. Happy birthday to you as well, Jim. Wow, yeah, there you go. And thank you, Rufus. So yeah, we saw the continued rebound from yesterday into the close, and some overnight gains as well in here for the major US stock indices. European stocks continue to stay positive. Japan positive as well, despite overnight. If anything, the overnight news has been mostly negative. So Euro area economy losing momentum, the EU says. ECB's Lagarde warns against hasty decision on rate cuts. The UK economy, the data shows we've actually, here in the UK, we fell into a technical recession in the second half of last year. We've got some other stuff in here. Japan's economy actually in a recession as well, shrinks unexpectedly in the final quarter of 2023. And so most of the stuff in here is actually quite negative on the overnights on the data side. But markets don't necessarily, this is kind of quite backward-looking data. Some of this is kind of expected. So even though kind of negative data and pushing back from Lagarde and the ECB on potentially quick rate cuts in here coming, not that they were going too fast anyway. We weren't expecting rate cuts until the summer out of the ECB. But most of the news you would see would be negative for, say, risk assets and equities, stock indices, which most of you guys are trading, are seen as riskier assets. So most of the news should be negative for those, and it's not been, overnight things are fairly positive. Let's take a quick look at some of that data in here. So here's the UK data in here today. So you can see the GDP data quarter on quarter for last year, preliminary data showing a minus 0.3 with a forecast of minus 0.1, and the year on year data minus 0.2 expected at 0.1. So that's certainly negative in here. Lagarde, as we say, has been speaking as well. Looking forward to today, the big focus in about 1 hour's time, core retail sales data in here. We have out, there's a little article I put up on sister site on FX Explained that I can share with you about both the US. We get UK retail sales, so we kind of merged them all into one in here. So where's the article? Here it is, here, the 15th and 16th preview. So this gives you a little bit if you want to have a look at that in here. Article actually put up by one of my sons in here. Luke put this up yesterday. So keep it in the family. So yeah, but looking ahead to the US and the UK retail sales. So that's the main data focus going into the day. Retail sales data in just under 1 hour's time. So we're certainly going to be keeping an eye out for that. At 9:15 Eastern, and then at 10 o'clock Eastern, we also get industrial production and business inventories, not usually big market movers. Later in the day, Waller is speaking at 1:15, and Bostic speaking then not till 7 p.m. this evening, New Eastern time. So keeping an eye out for all of that as we go into the session. So recapping 5 things to start your day. So as I say in here, tech continues to push high. We got back a big chunk of the losses from Tuesday after the CPI data, which was hotter than expected. A lot of those losses, over 50% on the major indices, up to 60+% back of those losses. And then Nvidia in here continues to be a positive in here. Remember, we've got Nvidia results next week. Overtook Google's Alphabet market value. So Nvidia now above both Amazon and Alphabet in here in market cap. Unbelievable, right? So there's the positivity around Nvidia, and its suppliers in Asia as well. So Taiwan's TSMC also pushing higher and helping, and the rally in AI-driven stocks in here helping markets higher. This is just point of interest. These are not really impacting us, but Michael Burry of the Big Short fame in here, betting on Alibaba and JD.com in here, Chinese tech giants, despite the big sell-off we're having in the tech sector in here. I'm kind of with him on that. Something that I'm certainly waiting to pivot into Chinese stocks in here as we're trying to find some bottom in the Chinese stock markets, with the global economy expected to avoid like a hard landing. Cisco cutting jobs, and in here, all eyes on the data. Obviously, actually saying here that there's a slew of economic reports here, though nothing at top shelf. Well, retail sales is relatively important, so I would be keeping an eye on retail sales today. Let's just run through some other stuff. So in US futures are up. Let's talk about this 5,000 level again. I think I mentioned this yesterday. When we hit like a big sort of psychological barrier, really it's only the first point when we go to it, and we saw when we went to the futures went through fairly easy, but the cash index didn't. And one of the main reasons, round numbers, I mean, they're important for a psychological reason, right? But one of the big reasons is around options. So options are of different strike prices. You don't need to know loads about options, but options are kind of bets on the market of whether they're going to get to certain levels or not. And all those strike prices for options are around round numbers, right? So it's like 5,000, 5,050, 5,100, whatever it might be, and you'd have call and put options, whether you think it's going up or down. There's various strategies, right? You don't need to know any of that, but what you need to know is a lot of the importance of round numbers is because of option markets, and they are around round numbers. And those options are then triggered when the market hits that level, right? So the fact that we've already hit 5,000, it can go up and down through 5,000. It doesn't really matter unless we go notably above 5,000. We're above it maybe for a few days and weeks, or not even days, really weeks and months. If we went up to like 5,200, then came back down to 5,000, then 5,000 may have some more importance, but really it's when we haven't been to a round number for some time. Okay, so the fact that we're up and down through 5,000 now is neither here nor there. So I wouldn't be using it as a support or resistance level. It's only really important, on a first visit. So, but anyway, up in here today. Pound lower in here. UK slipped into a shallow recession, and again in here, UK recession deals fresh blow to Sunak's economic promises. So we likely, just as we have the US election coming up later this year, at some point this year, we will have an election in the UK. Sunak is the Prime Minister here, making these, trying to stand on an economic front in here, with lots of issues for his party, the Conservative Party. But anyway, GDP fell 0.3 in the fourth quarter. 0.1 drop had been expected, so more negative than previously expected. Barr has been on the tapes in here. I think this was last night. Fed chair Michael Barr, this was from yesterday. Bumpy putt after 2% inflation means soft landing, jury's still out. So they're basically saying we've still got some ways to go. It's probably going to be sticky as we get there. And then are we going to avoid a hard landing? A hard landing being a recession in the US. The jury's out, he's saying. Are we going to get a soft landing or a hard landing? UK economy falls into recession again, adding to Sunak's election challenge, being covered there by Reuters. And Japan as well. Japan unexpectedly slips into recession. And which actually elevates Germany to the world's third largest economy. 2 straight quarters. Remember, recession, a real recession. Technical recession is 2 straight quarters of negative growth. Okay, so Japan doing that. We had Germany do it actually about 6 months ago, and the UK threatening it as well on that preliminary data that we had. But nevertheless, despite the fact that Japan has slipped into a technical recession, the Nikkei pushed to a 34-year high. So it just goes to show, right? It's not always about the data, and particularly this kind of GDP data, which is very backward looking, right? What the growth rates were, this is looking maybe at growth rates for Q4 of last year, right? And we're now the best part, we're 6 weeks away from that, right? And that's looking at data for the whole of the fourth quarter. So October, November, December, yeah. The markets and the economies are in definitely different places to where we were maybe back then. Again, Japan unexpectedly slips into recession. Germany now world's third largest economy. We've already spoken about that. And this was mentioned already as well. ECB must avoid hasty rate cuts, says Lagarde. So just moving on to looking at the Fed Watch tool, this has not really changed much since CPI. Pretty much no chance now of a cut in the March meeting. We already had that, but now fading chance of a rate cut. 60% chance now really sitting around there, that we're unchanged still in May. So the market now really looking for the first rate cut in here, and pretty much looking for, we'll definitely have a rate cut by June. But then if we look to the end of the year, remember, so if we start in June, we've got 1, 2, 3, 4, 5 meetings, okay, to the end of the year, including the June meeting. If we go to the end of the year, the 18th of December meeting, you can see that eventually when we get set, then the most likely scenario in here is at 425 to 450, which is, we're currently 525 to 550. So that's 100 basis points down. So it's 4 cuts. So the market's not even now, is only anticipating 4 cuts by the end of the year. And remember, the Fed tell us 3. At one point, the market was anticipating in here 6 cuts by the end of the year. So we've pushed back on that. We've gone from 4 with the Fed telling us 3. And that's not even then pricing in 1. Even if we start in June, there's not even 1 at every meeting. Okay, so the market is backed right off on that front. And if we follow up on there, we saw that big move down lower in bond prices, which is high yields, but we haven't a retracement of that across the board, as you see in here. And if we go and take a look here, I was messing around, I don't usually use this, but in here, I can't even take this off in here at the moment, which is very frustrating. But you can see we've retraced. So this was the big push higher in bond yields on the 10-year, and we can see we've retraced a significant amount of that now. We're over 2/3. We're through the 61.8% retracement of the move, and we can look at that on price as well when we come to the charts maybe. But the main point in here is we've on the 10-year anyway, we reversed. We pretty much neutralized the move that we saw yesterday in here. So I think that's interesting as well. And then all the risk then obviously we're going to kind of reject this kind of spike that we had in yields. And remember, these stock indices have done even better than that on their rebounds that we've had, which we'll come back to shortly. And just a quick nod to the overnights in here. Despite that negative data, look, the UK FTSE is unchanged on the overnight, with actually European indices, the German DAX, up basically 2/3%, and the CAC over 0.8% in here. Asian indices in here, despite that, Nikkei, as we said, Nikkei going to a multi-decade high, despite Japan's into recession. Remember, China, even though Hang Seng is trading in here, China still closed for the Lunar New Year. And going to the US markets on the overnight, obviously we saw that solid rebound. The S&P was up nearly 1%, having given lost 1.6% pretty much the day before on Tuesday, so recouped a whole percent yesterday. And if we go to the futures on the overnight in here, nudging higher as well in here, so the Nasdaq's up and S&P up between 1 and the Dow up between 1 and 2/10 on the overnights. Let's have a quick look. So here's the analysis in here that we put out after the close yesterday. So we spoke about this rebound having at the sell-off. Came off above both these two trend lines in here that we have on the Nasdaq, that go all the way back to October last year in the Nasdaq, and it's back to November last year on the S&P. So we held above and rebounded from above those trend lines. They're really strong trend lines in here, and we've taken back a significant amount of the losses that we were inflicted from Tuesday in here. And you can see in here, there's those trend lines, and there's the rebound in there on the Nasdaq, and similarly on the S&P. I'm just going to have to adjust the chart here on the S&P. Bouncing from above those. And if we look at where we are, we looked at these charts yesterday on the S&P. We were looking at these levels in here, the confluence, the 61.8 and the 50% of the sell-off from the top, or the sell-off from Tuesday. Well, we blasted through those yesterday, and also now through the 61.8. And we're not far about getting all of the sell-off just from Tuesday back in here. There's the Tuesday sell-off from the data. We're actually back at the same level on the S&P. So the S&P, that's the sell-off. That's when the data came out on Tuesday, this point here, and you can see we're right back at that level, and that's from the actual beginning of Tuesday, pre-data, and there's the high. So we're actually through the 61.8% retracement of the whole sell-off in here, and nearly got back 100% of Tuesday's sell-off, and actually back to the same point in here that we sold off from on Tuesday. And then in here remember we're looking at these resistance levels here, these retracements, various confluence of retracements yesterday on the Nasdaq. Well, we're now through the 61.8 1.08, and again that's where the sell-off came from there. So we're actually above the sell-off from the data, and actually nearly back to Tuesday's highs in here on the Nasdaq, and have neutralized the sell-off from the top, which was down through this up through 61.8. So all of it looks really bullish going into today for me. We're setting up bullish going into today. Obviously, we have in just under about 45 minutes now, we have the retail sales data. So certainly keeping an eye on that. I'd be in buy the dip mode, or if it just breaks higher, go with the break higher. So question from Jay. Hi, Steve. What happens if the first rate cut happens after the US election, say in December? I don't see that as a scenario. Often there is, so part of that may be in here the fact that they often don't cut rates around. I think that's why we're only pricing in, because the elections are in November, right? So what we're probably seeing, if we go and look on the September and November, September's pricing in likelihood at 450, 475. And then look, we've got the 450 and 475. What that tends to happen is the Fed try to be non-political. Okay, so they're not going to cut rates right before the election. Okay, obviously they need to do what they need to do, but it's almost seen as like bad form to, they don't want to be, because it kind of benefits the incumbent, right? So in this case, Biden and the Democrats. So they wouldn't want to cut rates right before the election. It doesn't mean they're not going to cut rates before. I don't see that as a scenario, Jay. But if the first rate, if they don't cut rates, the market's going to be, if we don't get a rate cut in June, the market's going to be super disappointed, right? So, and I think, the way the Fed have been speaking, they've basically pushed back on the May cuts, but they're almost flagging that we're going to get a rate cut by May, June. And so what you'll likely see is in the March meeting and in the May meeting, they'll certainly start to flag. The central banks are very, 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 very transparent. And they've already told us at the end of December that they're likely to cut rates 3 times this year in 2024. Now, that's what the last dot plot chart told us in December. So we have an anticipation of 3 rate cuts. So they're not. It's very unlikely that they would. But if they don't cut, by the middle of this year, it's either because the economy is doing super well and inflation's coming under control, and then that will be a positive for the markets anyway. So I don't see it as a scenario. They're going to want to start to normalize rates, and the only reason they wouldn't start to cut rates is if inflation started to tick higher. So that is a risk. If inflation starts to go up, they may not want to fuel inflation. But so that's the risk to that scenario. But the market's very much pricing in that we get the first rate cuts by the middle of the year, May or June, more likely June now. So I hope that answers the question. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Remember, happy birthday to me and also to Jim for tomorrow. So no webinar tomorrow. I'll leave a note in the chat in here underneath. So if you do forget and you wake up and you come onto the webinar, you'll see that there's a note saying no webinar. So the dot plot chart's going to be important. And I'm not sure when we get the dot plot chart doesn't happen at every meeting. It's like 3 or 4. I think it's 4 times a year. So we're probably due the next one. It might be the March meeting. It might not be till May though. We can double check on that going forward. So, but yeah, they don't do it at every meeting. I think it's 3 or 4 times in the year. I think it's 4 times a year. So we're likely to get it actually at the next one at the March. Okay. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. No webinar tomorrow, as I say. So have a great Friday, TGI Friday and all that for tomorrow. I'll be back with you with another bull versus bear webinar on Monday.